In 1899, the British Empire controlled a quarter of the Earth's surface and commanded the world's reserve currency. 50 years later, Britain was bankrupt, stripped of its empire, and relegated to a second-tier power, begging the International Monetary Fund for loans. The collapse didn't happen overnight through a single catastrophic event, but through a precise pattern repeated across 3 crises spanning 3 decades. Today, the United States finds itself following that exact same pattern. 3 financial crises in 3 decades have drained American wealth, expanded national debt beyond recognition, and systematically undermined the dollar's global dominance. The parallels are not coincidental or metaphorical, but structural and measurable, revealing a collapse mechanism that appears to govern how reserve currency empires end. Economic historians have identified a 3-stage collapse pattern that appears consistently when global reserve currency powers decline. The first stage involves an expensive foreign conflict that depletes reserves and reveals military overextension. The second stage manifests as a financial crisis that forces the abandonment of monetary stability and triggers currency devaluation. The third stage arrives as a humiliating geopolitical defeat that strips away the illusion of continued dominance and forces international financial dependence. What makes this pattern particularly dangerous is its deceptive nature. Each crisis appears manageable in isolation, and recovery seems possible after each shock. But the cumulative damage compounds across decades, quietly eroding the structural foundations that made dominance possible in the first place. Britain experienced this pattern between 1899 and 1956. The Boer War cost $223 million and exposed the limits of imperial power projection. World War I increased national debt from $650 million to $7.7 billion and forced Britain to borrow $4 billion from the United States. World War II left Britain with $21 billion in debt and dependent on American loans to survive, ultimately forcing the dismantling of the empire itself. The spacing matters as much as the events themselves. Each crisis arrived roughly 20 to 30 years after the previous one, creating just enough time for partial recovery to mask the permanent structural damage. The British economy never fully healed from the Boer War before World War I struck, never recovered from World War I before the Great Depression and World War II arrived, and never regained stability before the Suez Crisis delivered the final blow. Britain's 3 crises. Crisis 1. The Boer War, 1899-1902. At the turn of the 20th century, Britain stood as the world's undisputed superpower. The pound sterling functioned as the global reserve currency, backed by gold and guaranteed by the world's most powerful navy. British investments reached every continent, and London served as the financial capital of the world. The Second Boer War shattered this confidence. What was supposed to be a quick colonial police action in South Africa turned into a 3-year quagmire that cost $223 million, as equivalent to roughly $28 billion in today's money. More critically, it required mobilizing 450,000 troops to defeat 87,000 Boer fighters, revealing the empire's military inefficiency and strategic overextension. The war's financial burden fell directly on British taxpayers through increased income taxes and new borrowing. For the first time, international observers questioned whether Britain could sustain its global commitments. The gold reserves that backed the pound came under subtle pressure, and Britain's international competitors, particularly Germany and the United States, began closing the industrial gap. The foundation was starting to crack. Crisis 2. World War I, 1914-1918. Just 12 years after the Boer War concluded, Britain entered the catastrophic conflict that would fundamentally alter its position in the world. World War I cost Britain approximately $47 billion in total expenditures, peaking at 47% of GDP in 1918. The national debt exploded from $650 million in 1914 to $7.7 billion by 1919, nearly 12 times the pre-war level. Britain financed this war initially through gold reserves and overseas investments, liquidating centuries of accumulated wealth. When those ran out in 1917, Britain was forced to borrow $4 billion from the United States Treasury, transforming from the world's largest creditor nation into a debtor nation virtually overnight. The psychological and structural implications of this reversal cannot be overstated. In 1925, Chancellor Winston Churchill made the fateful decision to return Britain to the gold standard at the pre-war exchange rate of $4.86 per pound. Economist John Maynard Keynes immediately warned this would prove deflationary and destructive, forcing British wages and prices down to maintain the overvalued currency. Keynes was precisely correct. The decision contributed to persistent unemployment exceeding 10% throughout the 1920s and left Britain economically weakened when the Great Depression struck. By September 1931, Britain could no longer maintain the gold standard. A run on sterling reserves forced the government to abandon gold convertibility, and the pound immediately plummeted 30% in value. This devaluation represented more than a currency adjustment. It marked the moment when global markets recognized that Britain could no longer back the pound with the gold reserves and economic strength that had made it the world's reserve currency. Crisis 3. World War II and Suez, 1939 to 1956. World War II delivered the knockout blow to British global power. The war cost Britain approximately $21 billion in total debt by 1945, with a debt-to-GDP ratio reaching 270%. Britain had liquidated virtually all foreign investments, sold off assets at distressed prices, and leased military bases to the United States for 99 years in exchange for wartime supplies. The 1945 Anglo-American Loan Agreement reveals the extent of Britain's dependence. Britain received $375 billion from the United States at 2% interest, payable over 50 years. This wasn't Marshall Plan generosity, but a commercial loan with strict conditions attached, including requirements that Britain dismantle trade preferences within the empire and make sterling convertible to dollars. Britain didn't finish repaying this debt until December 2006, 61 years after the war ended. The Suez Crisis of 1956 provided the final humiliation. When Britain and France attempted to seize the Suez Canal from Egypt in October 1956, the United States immediately moved to crush the operation financially. The Eisenhower administration refused to support sterling as British currency reserves hemorrhaged, losing tens of millions of pounds daily. The United States blocked Britain's access to International Monetary Fund emergency loans until British forces withdrew from Egypt. Within weeks, Britain capitulated completely. Prime Minister Anthony Eden resigned in disgrace, and Britain was forced to acknowledge that it could no longer conduct independent foreign policy against American wishes. The empire that had ruled a quarter of the globe was now financially dependent on its former colony and subject to American veto over its strategic decisions. America's three crises crisis. 1. The War on Terror, 2001-2021. On September 11, 2001, the United States stood as history's sole superpower. The dollar dominated global trade and the central bank reserves, backed by the world's largest economy and most powerful military. America's debt-to-GDP ratio stood at a manageable 55%, and budget surpluses seemed within reach. The response to the September 11th attacks initiated 20 years of continuous warfare that would ultimately cost the United States approximately $8 trillion, according to Brown University's Costs of War project. The wars in Afghanistan and Iraq alone consumed $2.3 trillion and $289 trillion respectively through direct appropriations. These figures exclude the estimated $2.2 trillion in future veterans' care obligations through the next several decades. The parallel to the Boer War is striking. Like Britain and South Africa, the United States found itself bogged down in asymmetric conflicts that revealed the limits of military power. It took the world's most advanced military 20 years and trillions of dollars to fail at stabilizing Afghanistan, just as it took Britain 450,000 troops to struggle against Boer irregulars. Both wars exposed that military dominance doesn't guarantee successful occupation or nation building. The War on Terror fundamentally altered America's fiscal trajectory. The U.S. debt-to-GDP ratio climbed from 55% in 2001 to 64% by 2007, and the nation shifted from budget surplus projections to permanent deficit spending. International observers, particularly in China and Russia, began openly discussing alternatives to dollar dominance for the first time since the 1970s. The cracks were beginning to show. Crisis 2. The Financial Crisis. 2008-2009. Just 7 years after the War on Terror began, the United States experienced its worst financial collapse since the Great Depression. The 2008 financial crisis originated in the housing market but quickly metastasized into a systemic breakdown that threatened the entire global financial system. The crisis revealed deep structural problems in American finance that had been masked by debt-fueled growth. The federal response was unprecedented in scope. The Troubled Asset Relief Program authorized $475 billion in direct bailouts, with $443.5 billion ultimately dispersed. The Federal Reserve implemented quantitative easing programs that expanded its balance sheet from under $900 billion in 2008 to over $4.5 trillion by 2015, essentially creating trillions of dollars of new money to prevent system collapse. MIT researchers later calculated the total direct cost of crisis-related bailouts at approximately $498 billion, equivalent to 3.5% of 2009 GDP. But the broader economic damage far exceeded these direct costs. The crisis destroyed over $5 trillion in market value from the NASDAQ alone and wiped out decades of accumulated household wealth through home foreclosures and retirement account losses. Most critically, the crisis forced the United States to abandon any pretense of balanced budgets or fiscal restraint. The debt-to-GDP ratio soared from 64% in 2007 to 82% by 2010. The Federal Reserve's emergency monetary policies became permanent fixtures, just as Britain's temporary wartime measures became permanent features of its declining fiscal position. Zero interest rate policy and quantitative easing transformed from crisis responses to standard operating procedure. The new normal was anything but normal. Crisis 3. The COVID-19 pandemic, 2020-2021. The COVID-19 pandemic struck when the United States had barely recovered from the 2008 crisis. Federal debt had climbed to 108% of GDP by 2020. Interest rates remained near zero, and the Federal Reserve's balance sheet was already massively expanded with no clear path to normalization. The pandemic exposed how little fiscal or monetary capacity remained for crisis response. The fiscal response to COVID-19 totaled approximately $5.6 trillion in federal spending and tax cuts across 6 emergency laws passed in 2020 and 2021. The CARES Act alone authorized $2.2 trillion in relief spending. The American Rescue Plan added another $1.9 trillion in March 2021. More than 476 million economic impact payments totaling $814 billion went directly to households. The scale of this response would have been unthinkable in previous generations. In less than 2 years, the United States added pandemic relief spending equivalent to roughly 1/4 of annual GDP. The national debt exploded from $23.2 trillion in early 2020 to over $31 trillion by 2023. The debt-to-GDP ratio surged from 108% to 129%, reaching levels not seen since the immediate aftermath of World War II. Just as World War II forced Britain into permanent dependence on American financial support, the COVID-19 response has locked the United States into a permanent regime of deficit spending and monetary expansion. The Federal Reserve increased its balance sheet to $9 trillion during the pandemic, and any attempt to normalize monetary policy now triggers immediate financial instability, as demonstrated by the bond market chaos in 2022 when the Fed attempted modest rate increases. The trap had been set. The pattern suggests we are now in the phase Britain experienced between 1945 and 1956, when the empire still existed on paper but was functionally bankrupt and dependent on external financing. For Britain, this phase ended with the Suez Crisis, when America simply pulled the financial plug and forced British acknowledgement of second-tier status. For the United States, the equivalent moment has not yet arrived, but the conditions are rapidly aligning. The U.S. debt-to-GDP ratio now exceeds 125%, higher than at any point except the immediate aftermath of World War II. The national debt stands at approximately $36 trillion as of late 2024, with no credible plan for stabilization. Interest payments on the debt now exceed $1 trillion annually, consuming an ever larger share of the federal budget. The dollar's reserve currency status remains intact, but increasingly challenged. China has been steadily reducing dollar holdings in its foreign exchange reserves and promoting yuan-denominated trade agreements. Russia has largely divested dollar holdings following Western sanctions. The BRICS nations openly discuss creating alternative payment systems that bypass dollar settlement. Each of these moves would have been unthinkable 20 years ago, when dollar dominance seemed permanent and unchallengeable. History suggests the final crisis will arrive as a sudden loss of confidence rather than a predictable event. Britain didn't lose reserve currency status through a scheduled transition or orderly process. The pound collapsed in 1931 during a banking panic when markets suddenly recognized Britain couldn't defend the currency. The final loss of empire came in 1956 when America simply refused to support sterling during the Suez Crisis, forcing immediate British capitulation. The American equivalent might involve a debt crisis, where foreign central banks refuse to continue accumulating treasury securities at current prices. It might manifest as a geopolitical humiliation, where the United States attempts military action but is forced to back down due to financial pressure from creditor nations. Or it might arrive as a confidence shock where markets suddenly recognize that decades of deficit spending and monetary expansion have permanently compromised the dollar's stability. The timing remains uncertain, but the structural parallels are undeniable. 3 crises across 3 decades have drained American fiscal capacity, expanded debt beyond sustainable levels, and created dependence on continued foreign financing of U.S. deficits. The United States now requires approximately $1 trillion annually in foreign capital inflows, simply to maintain current spending levels and refinance maturing debt. The mathematics are inescapable. The conventional wisdom treats each crisis as an isolated shock, followed by recovery and return to normalcy. The 2001 recession was blamed on the tech bubble and terrorist attacks. The 2008 crisis was attributed to subprime mortgages and financial deregulation. The 2020 pandemic appeared as a random biological event requiring emergency fiscal response. But examining these crises through the lens of Britain's collapse reveals they are not isolated events, but connected stages in a single structural decline. Each crisis follows logically from the unresolved problems of the previous one, and each response compounds the underlying vulnerabilities rather than resolving them. The truly uncomfortable insight is that the pattern may be inevitable once it begins. Britain recognized the risks after the Boer War, attempted to restore the old order after World War I, and fought desperately to maintain empire after World War II. None of these efforts prevented the eventual outcome. The structural forces driving decline proved stronger than any policy response or act of political will. If the pattern holds, we are currently in the equivalent of Britain's 1945-1956 period. The crisis has already happened through COVID-19's fiscal response, but the system hasn't acknowledged the implications yet. Official policy still assumes American dominance will continue indefinitely, just as British policy assumed empire would survive even as the debts mounted and the power drained away. The question isn't whether America will follow Britain's trajectory. The three crises have already locked in that outcome. The question is only timing and the specific form the final recognition will take. History doesn't repeat, but it rhymes with disturbing precision. Three crises across 3 decades destroyed British dominance. 3 crises across 3 decades have created identical structural conditions in the United States. The pattern is complete. The ending may still be written, but the fundamental story arc was determined long ago.